Fred, you're here in studio. I'm going to start with you. Good morning. Thanks again for being here.
Morning.
As we look at the end of these quote-unquote Liberation Day tariffs, pause coming up, in about 2 weeks, even though we know it could even be longer because it's being battled in court right now, what does this all mean for emerging markets considering the other action we're seeing, the potential of a rate cut in the U.S. and then also a weakening dollar?
Well, everybody really wants to have clarity around tariffs, right? The earlier deal, the better. But of course, these negotiations take time and some are progressing faster than others. But with the risk of a slowing global economy, you really want to get that clarity on tariffs because it doesn't just affect trade, it also affects investment in these markets. And so you want to get as fast to a deal as you can.
All right. Tim, coming over to you. A lot of talk about emerging markets this year. Some of them have been outperforming the U.S. And you also say they're still trading at a discount. I'm looking at your research. You say emerging markets have a forward PE of about 12 times.
Yeah, look, EM typically is cheap to the U.S., and it certainly should be for a reason. But I think if you look at both positioning, if you look at valuations, we're at a time where, first of all, we've seen global fund flows readjust a lot of their destinations on the fact of both tariff dynamics and really just what's been going on for 5 to 10 years in terms of diversification of both central bank flows, central bank investments, and I think some of the foreign flows that come back as just a function of really where they are going back to historical norms. So I like EM on valuation. I like EM in an environment where, as Fred indicated, I mean, the dynamics around both trade and tariffs, and even the Fed over the last week, coming out of last week's Fed meeting, I think has been more, focused on easing than maybe they had let on to be. And this is very good for EM and EM currencies.
All right, let's talk a little bit more about EM, getting more particular about different countries. Fred, you gave us a couple countries that you believe have the best potential. I'm going to say potential to strike trade deals. A lot of different variables when we're talking about these trade deals.
You never know with these negotiations,
I'm about to say you said they were closest, but you didn't really say that. You said it has the potential to be the closest.
That's right.
It's India, Vietnam, and also South Korea. If you look at the charts, since the Liberation Day tariffs back on April the 2nd, South Korea, the EWY ETF, it's up more than 30%. I'm looking at the INDA and the VNM for Vietnam. They're both up right around 6, 5 3/4 and 1% for the second half of the year. Again, assuming that we see some movement on these deals, which one of these areas has the best potential to continue moving higher and have the best second half performance?
So these three markets, I think, stand out in Asia.
But is there one in particular?
So Korea, for example, we see great market performance. Now, the market is assuming that the tariffs will be manageable for Korea. We'll still need to find out, but that's essentially the assumption. But a point that Tim also made is fund flows flowing back into EM. In Korea, for example, it's a lot of Korean retail money that actually was long U.S. equities and has now kind of shifted back into being long Korean equities. And we see that in other markets as well. It's money coming back into these local markets, partly saying, U.S., maybe there's a bit of risk there, policy uncertainty, we're coming back into our markets. That's benefiting. There's a flow issue as well as kind of the tariffs being baked in already.
I'm going to go over to Tim to talk about Chinese equities, but I want to come to you. You actually gave me a really interesting stat. You said when it comes to China's GDP, only about 2.5% of the GDP is imports to the U.S. So the U.S. isn't that influential when it comes to their economy, according to your research.
Not that important. It's still important. If you lose 2.5% of your GDP, that's still going to sting. But it's not so the end of the world. But the rest of the world, exports to the rest of the world from China, is 12.5% of China's GDP. So they worry much more about the rest of the world ultimately than about the U.S. market.
Tim, coming over to you, talking about Chinese equities. Are you seeing opportunities in any particular places? We often follow the K-Web. Obviously, that's Chinese internet stocks. Are there other parts of China that you also see as being attractive at this current state?
Well, one of the things that I think investors in the U.S. have been very concerned about is even the discussions of delisting Chinese equities and specifically some of the big China tech companies. I'm not going to necessarily tell you I know what Washington will do on this front, but I do think that this is a case that really doesn't help. First of all, it only hurts U.S. investors. I think a lot of the companies like Alibaba and Tencent trade with enormous liquidity in Hong Kong. I look at Alibaba and I say this is not a company that won for the people that have been very concerned about China macro. A lot of the dynamics around Alibaba and some of the other major players in China tech have really been more about corporate governance and dynamics where I think these are national champion companies that have been given essentially the tap on the shoulder that says, all right, things are okay again. They've kissed the ring. Alibaba has 35 to 40% of their market cap in cash. Alibaba, I think, is well positioned in some of the same trends that have people very overweight U.S. tech, and I think some of those are around AI and cloud. Ali Cloud is a growing business that I think should be trading at a much higher multiple than it is. So it's some of the parts, its earnings multiple, and I think the governance dynamics around China tech are really fascinating.
So Tim, when you say these two names are also your top picks when it comes to Chinese stocks, because I think another theme that both of them kind of have is that they really generate the majority of their revenue inside of China, so they're not necessarily directly impacted by tariffs.
They're not necessarily directed by tariffs, and I think some of the the e-commerce dynamics are ones that are more a measure of really relative improvement over where some of those trends are. I also frankly think that if you're thinking about exposure to China, you're also thinking about some of the regional players, and that's been discussed. Whether it's Southeast Asia, some of these markets have been, I think, observed and underrepresented in U.S. portfolios. I think if you look at also some of the dynamics with, I know it's somewhat counter to what's going on today in oil prices and potentially commodity prices, weaker dollar has been very supportive to what's been going on in hard and precious metals. Those companies that are exposed to that portion of both the Chinese demand and I think even the commodities play related to Southeast Asia are very interesting here.